at Indicio Technologies, John Lackman, as well as our chief economist at Macrobond, Meghna Shah. Today's discussion will focus on the near-term outlook for two of Latin America's most liquid currencies, the Mexican peso and the Brazilian real, as we approach December 2025, and how real-time forecasting in Indicio can help shape accurate and a more comprehensive forecasting outlook. The backdrop is defined by a weakening US dollar, the US Federal Reserve's expected easing cycle, and local monetary and macroeconomic dynamics. This analysis will frame the key drivers, risks, and scenarios likely to play out and provide indicative ranges for both currencies. We'll also be discussing using mixed frequency data and the ragged edge in forecasting with Indicio. Now, our first question is to Meghna Shah. Meghna, the dollar index has weakened significantly in 2025. Could you elaborate on the dynamics behind the decline and what this generally means for emerging market currencies, please?
Sure. Thank you for the question, Kevin, and appreciate having us here. The question that you asked pretty much sets the backdrop for the conversation today. So the dollar depreciation has been a very distinctive differential movement that has impacted most asset classes in 2025. As a backdrop to this play out, several of these structural, political, and policy-driven uncertainties that played out in the US in the last 1 year are now visible in the labor market, in the inflation trends, in the overall GDP growth potential, as well as the inflation trajectory ahead. And to say the least, of course, the monetary policy bases these macro variables, right? Again, to say the least, these are explicit drivers of the currency volatility. And we'll break down these drivers and have a look at them individually as well as together for how they encumber a weak outlook for the dollar. So on the monetary policy front, in addition to the 125 basis points of rate cut that has already been announced by the Fed since September 2024, the futures markets are now pricing in an additional 125 basis points until Q3 2026. When we compare this rate trajectory to any other key developed market economy, the cumulative 250 basis points, both in terms of realized as well as expected rate easing from the Fed, stands much higher, making interest rate differentials that much more unfavorable for the dollar strength. So on the monetary policy, the rate easing cycle itself kind of adds pressure on the dollar. When we look at the other macro variables, just in terms of the overall debt itself, from a pre-COVID level of 105% to the GDP, we currently stand at about 120% of the GDP at the debt level. That only means pressure at the higher end of the yield curve, so higher nominal yields, and again, pressure on the dollar. When we talk about growth prospects, Fed's own estimates for 2025 peg 2025 GDP growth at 1.6%. This is much lower than 2.8% seen in 2024. And even the uptick for next year remains minimal. In terms of inflation, both PCE and core PCE are expected to remain above the target 2% until 2027. And with Fed easing, that only implies that Fed is probably okay with a higher tolerance for a little higher inflation. And that again means pressure on the dollar. And last but not the least, the labor market slowdown is evidenced in lag indicators such as non-farm payrolls, which have averaged just about 30,000 job addition on a 3-month moving average. To top it all, traditional correlations between the US dollar and macros, even if adverse, that usually used to support the dollar have broken down in 2025, right? So put all this together and the monetary easing backdrop, the fiscal concerns, lower growth trajectory, inflation concerns, only implies a weaker growth trajectory for the dollar, depreciation pressures, and that means almost a 10% depreciation that we've seen so far. Let me quickly share a chart over here. And the chart here indicates how the dollar has weakened almost 10% YTD. When now typically we talk about such an environment that usually is supportive for emerging market FX rates. So historically, whenever the Fed eases and the dollar depreciates, high carry currencies such as the Mexican peso and the Brazilian real typically tend to attract more inflows and hence appreciate provided the global risk appetite remains steady. Even this year, from this specific chart, you can notice the Brazilian real and Mexican peso have delivered a double-digit appreciation trend vis-a-vis the dollar weakening, which was also a very similar case back in 2006 and 2007 when global growth prospects were strong and these currencies attracted a lot of carry inflows.
Thanks very much, Meghna. My next question for you is, focusing more on Latin America, could you please shed some light on the Mexican peso outlook?
Sure, Kevin. So the peso remains very closely tied to Mexico's sensitivity to the US economy itself and the trade policies that the US announces. A quick glimpse over here indicates that exports form about 40% of the Mexican GDP. And of these 40% of these exports, almost 80% goes to the US alone. So bulk of say 30 to 32% kind of GDP comes from exports to the US itself. Needless to say, the US economic conditions have significant influence on the Mexican peso. But in addition to the highly correlated as well as the relative macro strengths for Mexico vis-a-vis the US, two key capital flows for Mexico, one, worker remittances, and two, the foreign direct investments have a significant bearing on the Mexican peso. Right? Let's just look at each of these and what's happening for those flows. So on the left, what you see is worker remittances. We've plotted year-on-year growth in the red line, which has contracted for the last 4 months and currently stands at about 4.7%. And we've plotted in the blue line worker remittances as a percentage of GDP. So between 2016 and 2019, the average was 2.7%, which then inched up to almost 3.7% between 2022 and 2024, and which has now kind of also softened at about 3.3%, right? So we are seeing that weakness in worker remittances. And if we look at the bottom chart, these are the mean and median trends since 2018, and the last 4 months, the growth rate actually stands lower than the mean and median seen in the last several years, right? But however, some structural support still emanates from the FDI flows tied to nearshoring, which continues to anchor medium-term expectations for the Mexican peso. So the chart here shows that these are the annual FDI flows into Mexico, and whenever we see significant surge in FDI flows, there is a significant appreciation in the currency as well. Right? And at the bottom, you see the quarter-on-quarter momentum for these FDI flows, which has inched up since 2022, and that has supported the Mexican peso. Let us also look at, apart from the macro and the fundamental drivers, let us also look at Quant Insight's classification of what macro factor sensitivities, the top 7 sensitivities that the Mexican peso has. And obviously, Mexican GDP, US GDP, US 10-year yields, and Fed rate expectations have a significant bearing on the peso outlook. Right? This only substantiates when we forecast the Mexican peso. We consider various explanatory variables such as the current account deficit for Mexico, the exports to the US, the interest rate differentials between the two economies, the growth differentials between the two economies, and a lot of financial market volatility indicators such as VIX to forecast the Mexican peso at about 19 going into year-end December 2025, with the bull and bear case at 18 and 20. Now that is nestled between the Mexican policy rate in green and the Fed policy rate, both of which have seen an easing in the last 1 year.
Thanks, Maggie. Now, moving on to the second major LATAM emerging markets, how different are the prospects for Brazil, given its varied macro dynamics compared with Mexico?
Sure. So Brazil is relatively a very different story from Mexico. It runs a trade deficit with the US, however, remains less reliant on exports to the US compared to Mexico. As a composition, if we have a look at exports, they just form about 15% of the GDP versus Mexico, which stood at 40% plus, right? So the Brazilian real, being a high carry, a high beta story, remains highly sensitive to domestic conditions as well as global financial market conditions impacting the commodity cycle. So for Brazil, external demand for iron ore, for soybean, for oil, they typically shape flows. So if we just look at the region-wise exports for Brazil, on the left-hand side, you see the green bar, which indicates almost 48% of Brazil's exports are to Asia, and of which 30% comprises to China alone. Now, between 2021 and 2023, this proportion has gone up from 40% to 48% currently, while during the same time, for US, exports have actually inched down and currently stand at just about 10%. If we also look at the breakup in terms of the commodity-wise exports, we are seeing a surge in agri-exports from Brazil to other countries, and hence higher reliance when we talk about the commodity cycle or when we talk about financial market conditions or growth conditions in globally that will impact the Brazilian real more than exports to the US itself. Now, one condition that also impacts Brazil significantly is the fiscal condition. So Brazil is currently balancing a delicate fiscal situation where both government spending pressures are building while debt servicing costs are also higher. We've seen that in the past as well, when between, say, 2014 and 2020, the red line, which indicates debt as a percentage of GDP, was rising sharply. There were also depreciation pressures on the Brazilian real. We are seeing a similar trajectory in 2025, and that probably markets hence will also be closely watching this fiscal trajectory, especially as we move into 2026 with the election cycle, where pressures on revenue spending will be higher, and hence debt levels likely to be higher further in 2026, right? Which imparts upside pressures on the Brazilian real. But so to say, if we have a comparison between the three countries that we're talking about here, Brazil has actually seen a different trajectory on its policy rates. Unlike most global economies, it has hiked. The central bank has announced 450 basis points rate hikes since September 2025, taking the Selic to 15%. So while Mexico cut rates, US cut rates, and both their currencies, so dollar depreciated, the Mexican peso appreciated, we saw a significant support to the Brazilian real coming also basis the monetary policy tightening. When the rates are higher, that gives a strong carry advantage for the real, and especially if the Fed continues to drift lower, right? This is seen in the fair value model. This is Quant Insight's fair value model for the Brazilian real, where the spot prices are actually lower than what the model expected. When we also look at futures markets over the last 1 year, 2 months ahead Brazilian real forecast futures value, the spot rate actually outperformed, implying a positive carry, right? So to that extent, the Brazilian real outperformed the market expectations as well as the model expectations. And when we talk about monetary policy trajectory ahead, inflation in Brazil probably will still remain above 3% going into 2026, which means that the central bank will be a little cautious in going about too quickly to announce rate cuts, right? So for Brazil, again, when we look at the macro factor sensitivities, we spoke about the global growth conditions, we spoke about the commodity cycle, and that's what's exactly implied by the 7 top factors which determine the Brazilian real trajectory. So for now, it also gets influenced by the CDS seen in emerging markets, as well as the China 5-year CDS, which plays a significant role. These macro factor sensitivities actually drive the impact, the beta for the real, and hence are relevant when forecasting Brazilian real. We take into consideration all these market factors as well as macro factors, which impact the beta for such a currency. And we forecast the Brazilian real at about 5.5 going into December 2025. This, of course, is a highly sensitive currency. So the bull case, bear case are a bit wider in terms of the confidence intervals. But that's what Indicio also helps in terms of accounting for those confidence intervals.
Thank you very much for that overview, Maggie. Now over to John Lackman from Indicio. Hi, John. Could you please provide some more color about the charts that Meghna has shown us today, please?
Yeah, of course. And also thank you, Maggie, for the overview. So just to give you a quick introduction to the tool that Maggie has used to make the forecast. Indicio is a web-based forecasting tool which packages knowledge from experts, academics, researchers in a way which makes it easy and also a bit fun to use. The idea is that you shouldn't have to be a professional programmer, quantitative analyst, all those different things in order to be able to make a good forecast. And this we partnered with Macrobond in 2022, and it's been a great partnership since a good forecasting tool is really nothing without a good set of data, and Macrobond's global database is now integrated in Indicio, and it really helps both bringing sort of the data that you need always at your fingertips into the forecast, makes it really quick and easy to work with. And this is designed for a lot of different roles, but among them are analysts, economists, portfolio managers, and strategists. And the general idea is that we build automatically a large set of different models, evaluating both different models and different variables to help us make as good of a forecast as possible of the variable that we're targeting. And all this is done with integrated back testing. So we can see here, I have an excerpt of what it might look like. You see some models have a very good accuracy. They're very appropriate for forecasting this specific data, whereas some other models may not fit all that well. And this really shows that it's important to evaluate different models, since imagine you just evaluate one or two models, and those would have been sort of the worst models for this set of data. Yeah, so that's a quick overview of the tool.
Thanks very much for that, John. And as a follow-up question to that, LATAM economies generate signals at different speeds. For example, daily FX, monthly inflation, quarterly GDP. How does Indicio bring that together into one forecast?
Yeah, thanks again for the good question, Kevin. So Indicio supports some models that apply something called mixed frequency. And this means that you can have different indicators at different frequencies going into a single model. And one example might be that you're making a GDP forecast where you use both perhaps inflation, but maybe also FX or the oil price. So much faster moving indicators. And if you're halfway past the quarter, you may already have some observations in that quarter from the monthly or the daily, or perhaps also weekly variables. And what Indicio does is that we build these types of models, which can take all the different frequencies all at once, and we replicate. So we also do back testing of these models where we replicate sort of the shape we see today, where we have some observations going into September on daily variables, some observations going into the quarter from monthly variables, and we back test. So we get sort of a sense of how useful are these different higher frequency indicators in making our forecast more accurate.
Thanks very much for that, John. And a second question for you. Forecasting in Latin America often means dealing with shocks or incomplete data. How does Indicio's ragged edge feature handle those real-time challenges?
Yeah, that's also a great question. So a lot of the time, even if you have access to the great database in Macrobond, Macrobond don't control when different government agencies release their data, and a lot of the time they don't release it as quickly as we would want them to. So a lot of the time we end up with a situation where we have one target variable which ends at one date. Then we have some different indicators that might end 1 month before, 1 month after. I've seen extreme cases where we have a variable that ends 4 months before, since no releases were made for one or another reason. And if we consider sort of the common case where you have all variables in the same end at the same date, you would have a straight edge, so to say. But if we have a ragged edge, which is more a realistic scenario, we need to handle that somehow. And two common approaches exist from before. One is to just cut the data and throw away some of the last observations. And another approach is to nowcast. Both have the downside of either throwing away useful information or just introducing uncertainty in the most important information. But in Indicio, we support full ragged edge forecasting. So we build the models considering the ragged edge. And just as for mixed frequency, we're also able to extrapolate or sort of project back that ragged edge in the past in order to backtest. And this can tell us that we may believe that GDP is really important to forecast a variable, but since it's released so slowly, it might not be that useful since we're always going to be waiting for the last observation. That's sort of the outline of how we can handle ragged edge.
Thanks very much for that, John. Very much appreciated. So thank you, John and Meghna, for your overview of our topic today. And now that we're over 20 minutes into our webinar today, I'd like to open up for live Q&A. So for all the attendees in this webinar, please post your questions in the chat and we can get to them as soon as possible. We did have two questions in advance that I'd like to ask both Meghna and John today. The first one is to Meghna. You mentioned Mexico's sensitivity to US economic growth and uncertainties tied to the trade policies this year. Can you highlight what GDP growth projections look like for Mexico, and how does the same comparison stand for Brazil?
Thanks, Kevin. So from the earlier feared uncertainties going into the year in Q1 and Q2, where we saw muted growth rates for the quarters, such as 0.2% and 0.6%, Mexico's GDP growth for 2025 stands a tad bit revised higher to 0.6% from full year growth of 0.2%. However, that still remains significantly lower to 1.4% that we saw in 2024. For next year, that again becomes a weak base, and we expect the growth rate to be around 1.1% for Mexico. When we talk about US, for US, the Fed projects 1.6% this year and 1.8% next year. And for Mexico, that implies 0.6% and 1.1%. In a nutshell, for Mexico, the medium-term outlook, the long-term outlook still remains constructive. Mexico as a key supply chain hub still remains kind of guarded from the US-Mexico-Canada agreement, whereby almost 80% of Mexico's exports to US are duty-free. Again, with tariffs implied on China from the earlier year at a significant, almost triple digit percentage has come down, which means the effective tax rate on Mexico is just about 7%. And to that extent, both in terms of exports to the US as well as a global supply chain hub, that pretty much remains intact, which keeps the the medium-term outlook quite constructive on Mexico. And which is why for Bank of Mexico itself, there's just one more rate cut, which is expected for this year. So from 7.75% to 7.5% going into the year end. For Brazil, these numbers are a tad bit better. We did mention that its reliance on exports to the US is lower. And hence, from 3.4% in 2024, Brazil is expected to grow at around 2.2% this year and about 1.8% next year.
Thanks very much, Maggie. Second question is for John.
Mm-hmm.
If data is released on a very uneven schedule, what are the limitations of how ragged of a ragged edge can be handled?
Oh, yeah. So that's a good question. So let's say we have an example where we have one of those really slow moving publishers of data. I think I saw in one data set that Maggie worked with when preparing this, she had unemployment for Brazil was only released for December. And of course, the other variables are released on a much more timely schedule. When we backtest a model and evaluate that variable, we will usually see that since we don't have data for the last 6 months, and we wouldn't have sort of when we back project it to get the same shape of the ragged edge whilst back testing, we would most probably see that that variable is not going to be too helpful in forecasting forward, even if it's like a very important variable theoretically. If we don't have the data, we don't have the data. So that's going to show itself quite clearly. So there's really no technical limitation. It's rather a limitation in that if we lack too much data, we will not really benefit from that variable. The other sort of opposite case is when you have a variable that protrudes far past the variable that you're trying to predict. Then that variable is usually going to show up as really useful. And it's not really as realistic of a case that a variable is going too far into the future, but you could, for example, add in a forecast and predict what would the model have said if we would have made a variable which always had a forecast going forward.
Right. Well, it looks like there's no more further questions coming into the chat. So what we'll do is we'll wrap up today. Really wanted to extend a big thanks to both Meghna and John for presenting today, as well as everyone who has been able to attend this webinar. Thank you very much and have a great rest of your day, everyone.
Thank you.
Thank you so much.
Bye.